Okay, good afternoon, everyone. Thank you so much for joining. My name is Marcos, as always, the portfolio manager here at Stock Specialist. Hope everyone is doing quite well. Good to see we've got quite a lot of support and a lot of registrants coming through for today's webinar. We'll be particularly be focusing as well today on how the banking crisis, I say banking crisis, over the last couple of weeks has essentially divulged the market into quite a bit of turmoil, and how we can focus on actually retaining our clients' capital and your own investment portfolios, particularly in the commodity space as well today. So thank you everyone for joining, and we'll get stuck right into it. Okay, and as always, just as a general disclaimer here, all advice provided within this webinar is just general advice only. If you do require personal financial advice, please see your registered financial accountant or broker. Okay, so a lot of things going on in the last couple of weeks. We've been focusing, particularly the market has been essentially what basically a pinball machine. 1% up one day, next day 0.9% down, 0.9% down again. Particularly focusing on what the monetary policy that has been implemented, coming particularly out of the US Federal Reserve, which we will touch on as well. We're going to provide our forecasts on where the market's actually heading. Of course, our three top stocks currently, what we're looking at the moment, how our portfolios are going, and of course, our trajectory going into the rest of the year. So this week, very mixed signals being sent out to the market. You can see there, Bank of America, recession fears are up in March. The morning catch up, again, banking fears are subsiding. US recessionary risks are now quite a lot higher. And banking turmoil, particularly coming out of Credit Suisse, which at the previous, well, at their most recent current market capitalization, was valued at about $10 billion. And their Switzerland rival UBS was able to provide a takeover offer, which was supported by the Swiss Federal Bank and the Swiss government as well, for about 4.5, essentially acquiring one of their biggest rivals formerly over the last 10 years for about a third of their market cap. Also taking into account their debt losses as well. And we had as well two regional US banks, California-based bank, Silicon Valley Bank, which I spoke about a couple of weeks ago, I believe. The venture capitalist bank, it's primarily focused on cryptocurrency investments and a lot of venture capitalist firms as well. And of course, New York Signature Bank, the second and third largest bank default over the last, since the Lehman Brothers in 2008. So a lot of turmoil coming into the financial markets. However, the US Treasury Secretary Janet is pretty happy with how the US government has approached the financial markets coming into the US, and honestly, they've done quite a good job. They've been able to support depositors' money above what is the usual $250,000 deposit limit that's actually supported by the US industry. They're essentially keeping all that money across, and the US banking sector is seen as sound, which is true. However, that of course has direct flow-on effects to how the Australian financial sector has been performing as well, which I'll touch on a little bit later. But you can see there, world central banks have rallied together after the UBS took over, embattled Credit Suisse. I would say embattled. I don't know if embattled is the right word. They've been on the wrong side of the financial sector for the last probably 5 years. However, Credit Suisse has still maintained a domestic presence as well, particularly I think their office was there in Pitt Street in Sydney for not too long ago. But however, they've been primarily focusing on their Swiss and their debentured capital notes over there in the US and Europe. But Credit Suisse, unfortunately, or fortunately, has now been taken over. You can see there the bank crisis and where that dipped So you can see the ASX 200 was sitting around 7,300 points. And then once that UBS takeover announcement was announced, currently trading about 69.50. And we're still sort of hovering around that amount. As I mentioned before, it's a little bit of a pinball machine. We don't really know what's going to happen on the next day, but a lot of this volatility is actually making quite a lot of money for a lot of shorters, a lot of CFD traders, a lot of swing traders as well, which we've been looking at quite interestingly. So the US Federal Reserve, that came out obviously on Thursday. As widely expected, the US Fed increased their basis point federal funds rate by 25 basis points. Initially, a couple of months ago, we were expecting, of course, a more hawkish stance, approximately 50 basis points. But the US Fed has, of course, acknowledged that the of course, hawkish stance that they've taken from about next to 0% cash rate to now almost 5% cash rate has, of course, had a direct impact on the financial system as a whole. You can see there 2022 post-COVID pandemic sitting pretty much at record lows, and now we're back up to 5%. But what's interesting is the futures pricing, that's what the median dot indicates, essentially is pricing currently what the market actually is pricing in, what the US Federal Reserve will do, is looking at about a 5 to 5.25% cash rate throughout 2023. So they're still expecting a little bit of a pivot. And when I say pivot, essentially looking towards the later end of the year, hopefully either stagnating, not increasing interest rates any further, but possibly decreasing them, which would of course have a fantastic impact on the equity market as well. But we'll have to wait and see what's going on with particularly with the US CPI going forward. Taking a quick look domestically, discretionary tech industrials have outperformed, right? We've mentioned this a couple of times before, particularly how the top 5, the top 10 actually, the top 10 stocks on the ASX 200 have had quite a saturated market share of the index for quite a while. Essentially looking at lower risk stocks. But you can see there, in the last month, even BHP, despite having quite a stellar run for the last 12 months, is down about 10% in the last month. CBA, taking a look, of course, as that direct implication of the US economy, having a direct impact on the financial sector in the ASX as well. The CBA share price was, I think, all-time highs was trading about 110, 112. We recommended we reduce on a lot of the financial sector, particularly with CBA, for quite a while. Currently trading about $96. Looking, depending on, of course, how the domestic real estate market is going forward. CSL trading at 284. A lot of clients looking at that one, peaking at about 310. NAB and Westpac following suit, about 7-8% down in the last month. So the question is, as you can see there on the top, where exactly do we invest if we can't trust our top 5 stocks on the market? So hey, that's exactly what we're here for. So we're focusing, particularly now, looking in this commodity boom, we're focusing on commodities that will have medium to long-term throughput in terms of how the pricing and the pricing metrics have been working. Okay, so the first one, it's something that I've only probably mentioned maybe once before, but it's a company called Bisalloy Steel, BIS. All right, and the reason, not necessarily that they're a commodity miner, however, they're a manufacturer of high strength tensile steel products for the defense industry primarily, right? And they've had quite a significant uptick in the share price over the last couple of years, particularly over the course of the Russia-Ukraine conflict. And going forward, they've still maintained, and this is something that is very consistent, and a lot of our clients have been really appreciative of the stability of the dividend. That dividend yield there that I've posted that was actually based on the $2.04 pricing. However, it's currently trading, I think, about $1.94, so it's a little bit lower there. So based on that current price, the dividend yield is currently sitting at 7%, fully franked. And having that dividend stability, consistent revenue growth, we've seen a lot of defense. The defense market, of course, in Australia is quite saturated. You've only really got a couple of different stocks that are focusing primarily on defense. You've got Bisalloy Steel, of course, having the Bushmaster, that is, of course, being exported and utilized in Eastern Europe currently. And you've got a couple of other companies like Codan, which utilize communication services as well for the defense industry, and XTX, which is XTE, the ticker code is there, that utilize a lot of demand from their body armor and steel products there. So really saturated industry. But Bisalloy has consistently had this revenue growth, and this is something that's quite interesting. Despite, you can see that obviously in the last financial year, the EBITDA has increased quite substantially, and that of course was off the back of the Russia-Ukraine conflict. But despite that, even going back as far as FY18, the consistent revenue growth has been something to really take a look at, take advantage of it. The COVID pandemic really didn't impact that too much because they have long-term contracts with the Australian Defence Force, as well as international military bodies as well. Okay. So primarily their production centers are in Australia, in the Unadera region, and China as well. But they've got a couple of joint ventures as well, with the likes of Thailand, Indonesia, and China. And their raw material product suppliers, of course, for their steel, okay, of course, comes from really high quality product supplies. Number one being from the China region, Shandong Steel, South Korea POSCO, which is also a huge product supplier as well, and Australia with BlueScope Steel. Okay, BlueScope Steel, which funnily enough is another recommendation that we provided back when BlueScope was sitting about $15-16 per share. It's currently trading about $19.50, $20 per share. Not bad. Those sorts of recommendations, when you're looking at the interchangeability between corporate suppliers and international suppliers, having those long-term vendor relationships really help the lower and mitigate the costs of the company. So, and then of course the products are actually shipped to quite a vast majority of countries, as you can see there on the bottom right hand side of the screen. All right, so the industry breakdown as well. I've been focusing a little bit too much on the defense side of things, but you can actually see the industry breakdown. 58% of the industry breakdown of where their products are utilized are in the mining industry as well. So those high tensile steel products are primarily used for various mining services companies, utilizing for, of course, anything, say, with reverse circulation drilling to, actually creating mining products, magnetics, large lead items as well. That's the high quality and the strong reputation they've had for durable steel products, which I think this chart really simplifies that in a great deal. And of course, you've got that thematic going forward, particularly with the defense industry, looking forward. So you can see there in the middle pie chart there, defense currently incorporates about 21% of the industry breakdown, but they're looking to expand that quite heavily, which of course includes higher margins as well. And this is probably my favorite chart when it comes to Bisalloy. You can see the amount of notable clients that they have. Of course, BHP, right? Rio Tinto, we all know them. Those are their major clients, of course. However, a lot of wholesale names, a lot of well-known names in this chart here. South 32, Whitehaven Coal, Oz Minerals, Newmont, Newcrest. I mean, all of these large blue chip companies that have direct contract ties towards Bisalloy. Yancoal as well, being a star, Westtrack, all these really strong companies that have long-term contracts, particularly for that high quality steel. So definitely something to take a look at. Over the long term, look, Bisalloy hasn't, it's not like it's done a 10x or anything like that. However, over the last 5-year period, they've done a capital growth return of about 110%, okay, which is pretty fantastic. Taking into consideration as I mentioned before, the dividend stability that they've been able to provide, about a 7% dividend yield consistently, something that's underlooked quite substantially. People primarily focus on companies like Fortescue with their high dividend yield. However, with the iron ore price, constantly changing, Fortescue has not had the amount of dividend stability that, say, a company like Bisalloy has had as well. So it's something particularly for our income investors looking for that high dividend yield will be useful for. So the next one we've got is Newcrest Mining. I think I mentioned this one a couple of times, but this essentially is looking forward. We've had a lot of clients inquire, particularly about the gold price. The gold price is currently sitting very, very close to about 2,000 US per ounce. We've been recommending companies such as Newcrest, as well as Northern Star as well. We recommended Northern Star to our diamond members, approximately about $7.50 back when the gold price was trading about $1,550, $1,600 per ounce off the back of high Chinese demand, right? And now they're currently sitting about $12, right? So that's not bad, particularly for a gold stock. But Newcrest as well is one that we really like, particularly for their increased involvement in the US sector, and of course the Newmont takeover offer. So that initial takeover offer was rejected because they were looking a little bit opportunistic coming in to take over Newcrest, particularly with international companies having jurisdiction and having ownership of Australian-based mines. We already have enough of that, to be fair. So Newcrest is looking to, of course, at least engage to get a better takeover offer. Newmont, of course, is the largest gold mining company based in the US. So they've got quite a lot of interest coming through. And this one I've already mentioned before on a previous webinar. However, they have a high quality portfolio looking not just in the Western Australian region, but also in Canada and also in the Southeast Asian region, as well as South America as well. Their all-in sustaining costs have actually maintained quite well as well compared to a lot of other gold miners. So you can see there the FY23 production guidance for their primary two miners, which is Cadia and Lithir. Cadia is in the New South Wales region, I believe, looking to produce about 600,000 ounces on average for the financial year, and the Lithir looking at about 750 to 800,000, most likely looking towards guidance. And now with the current gold price that they're currently achieving, these contract prices will be achieving them quite high margins. So definitely something to look at. And you can see here the half year 23 highlights, about 1,000 kilo ounces, so 1 million ounces of gold production, up 25% on the previous corresponding period. Statutory and underlying profit of almost $300 million, which is pretty good. And they also paid off that credit facility, which I mentioned before, with London Gold. They had $173 million worth of that debt facility, which they've actually paid off. And if you're looking, of course, which a lot of our clients are, love those dividends, the interim dividend was announced for US 15 cents per share. On top of that, a special dividend of US 20 cents per share, both fully franked, which is great. So that actual 2.52% dividend yield is actually quite higher because all of these dividends they've been providing are, of course, all fully franked. And that's actually probably the highest compared to a lot of other gold miners out there. So that KDA expansion is looking to, of course, also do a two-stage plant expansion. That's now completed. So now they'll have a mill throughput of about 35 million tons per annum. Right, that's commenced Q2 FY23, which is essentially, that means it's starting now. I don't think the NPV has been really taken into account there, but that's exactly why we're looking at it, right? A successful investor is always somebody who has the capacity to look forward and be able to forecast that. So we're looking particularly at that stage 2, NPV over a 16-year mine life, 1.4 billion. Really something to look at. First gold and copper production for that KDS stage 2 is expected in FY26. So who knows what the gold price will be then, but the copper price will definitely be going upwards as well. We should probably do a copper webinar as well. But Newcrest miners, you know, as a largest copper producers, there aren't a lot of copper miners out there as well. You've got companies like 29 Metals as well that done relatively okay. But the copper price is something that is highly relative to, of course, global demand. And copper is essentially 100% recyclable. So the supply side of the copper, well, of course, of copper is actually quite high compared to your other base metals or your precious metals. So just year to date, Newcrest is up about 23.8%, not too bad. It's currently still trading about that 25.80. I would give you a target price, but that's only something I can give to our members. But we are obviously still quite bullish on the Newcrest mining share price going forward. All right, so the final one, and this is something that a lot of clients have been asking about. We've obviously seen quite a retracement in the lithium price over the last 5-6 months, since November 2022, when the lithium hydroxide and carbonate prices sort of peaked. We've seen about a 30-40% retracement in terms of all-time highs of the actual lithium carbonate equivalent price, currently sitting about 45,000 US per metric ton. However, Pilbara Minerals, people don't actually realize that the lithium carbonate equivalent price doesn't affect their net margins. What they trade in, of course, is the lithium spodumene price. So the spodumene price is directly impacted based on what their contract prices are doing. Pilbara announced a couple of months ago, which I think was pretty much lost on the market for a little bit, but they they renegotiated with their major contractors and their major customers to sell their spodumene at about 6,500 US per ton, which is already locked in. Contracts are signed, it's all there. They also announced an inaugural dividend payment of 11 cents. The payment date is today, so apologies for all the webinar viewers who actually didn't get into Pilbara. But this was one very solid example of how we were able to provide this particular stock, and especially when you're looking at the lithium sector as a whole. Not a lot of lithium companies actually pay a dividend at all. You've got some New York Stock Exchange listed companies such as Albemarle and SQM that have a dividend yield of about 1.5–2%. Nothing fantastic. However, Pilbara, in terms of Western Australian jurisdiction, they're currently looking at about 7% dividend yield, which I'll look into that a little bit further. But their production and sales quarter on quarter on the last half year have of course gone up. That's not really relevant. This is the chart that you really want to be taking a look at. So currently with their P680 expansion, essentially P680 meaning 680,000 tons per annum of production, is on target and to meet delivery schedule as well. But most importantly, always, which is probably the most important thing, is within budget as well. And of course, they're looking to receive a P1000 expansion, which is 1 million tons per annum, which FID is looking towards within the next couple of months as well, which is very exciting. Okay. So yeah, this is the big one that I wanted to mention. So that inaugural dividend that was paid, 11 cents. It's actually payment date today, but don't fret. That was essentially just the first dividend payment. Nothing too crazy there. Essentially, they paid about 20% of their free cash flow out of that. And the capital management policy that Pilbara has in place currently is looking to pay about 20 to 30% of their free cash flow out as dividends. Okay, the reason for that, and they're making a little bit of a minimalistic stance, is because they want to utilize the amount of free cash flow that they have on hand, which is looking towards the side of about $3 billion by the end of the financial year, to actually expand their growth strategy and their capital management there, which I've noted on the P680 project, which I mentioned, the P1000 expansion project, and of course their downstream and midstream joint ventures with POSCO and Calix as well. So, for example, they have about they have the expansion opportunity to take about a 30% joint venture opportunity with POSCO, which is a lithium chemical producer in South Korea, which has done really well. POSCO is actually building a lithium hydroxide plant in South Korea, which Pilbara will have about a 30% stake in as well. Okay, so just as a recap, in terms of our income portfolios, and now this is actually better. So this is something that was really interesting. To our top picks, for example, I can't tell you exactly what it is, but for example, one of our top picks on the income portfolio has actually returned 17% year to date. Our income portfolio now has actually, of course, been tailored to a lower risk, higher yielding stocks. Now, with a little bit more of this capitulation that's going on in the market, we're of course seeing higher dividend yields because of the lowered pricing, which has done really well for a lot of our more stable clients and a lot of more stable investors. Our growth portfolio has also done quite well, as you can see. Really fantastic recommendations coming out of there. Our top one doing 74.4% year to date. Again, can't tell you that one. But our mining portfolio, and this is a very similar trajectory as to what I was saying before. It's not necessarily everybody can tell you when to buy a stock. Of course, when the market's low, when you're in a bull market, of course, you can essentially throw a dartboard and you can pick a relatively good stock. You'll have probably a majority chance that the stock will do well. However, the more important thing is actually knowing when to reduce or when to sell, right? So you can see there are a couple of ratings. We don't recommend buys on everything, and that's exactly where we differentiate ourselves from other people. It's knowing when to sell, when to take profit, when to reduce, particularly on how the market is changing fundamentally. So how do we identify that? Well, we identify it, of course, via, of course, our technical analysis, but primarily fundamental analysis. We opportunity look at top-down approaches. Okay, top-down essentially meaning looking at the macroeconomic context, figuring out how the economy is moving, identifying what sectors are outperforming and what will outperform, and then of course going through step by step and identifying which particular companies within those sectors will actually outperform. Of course, everyone's financial and investing situation is different, so of course we tailor our recommendations to our particular clients as well, and that's how we focus on investing in simple, stable healthcare consumer goods sectors. For example, this one I can give. A lot of clients were asking, particularly, say, for example, in the healthcare. It's technically not healthcare stock, but everyone knows it as Medibank Private, MPL, after the cyber attack that occurred over the last few months, when Medibank was trading about $2.50, $2.60 off the back of that. And we recommend it as a contrarian buy, high conviction buy. Putting that now, it's currently trading about $3.50, right? Still with a 5.5% yield. And those are very simple situations where we noticed that the company was obviously quite oversold, particularly on a technical analysis basis and a fundamental analysis basis. So it was quite simple for us, but it's not necessarily simple for other investors. And that's not the kind of advice that is quite prevalent within the market. All right, and I mentioned a few times today, I'm not going to go too much into it as well, but the dividend stocks, right? Having a predictable and a stable dividend yield is much more important than having a high yield one half year and then not having a dividend at all over the next 6 months. And of course, our base and precious metals, which is exactly where our commodities sector push has really come from and what's actually been really helping our clients going forward. So, just for our webinar viewers, I just wanted to touch on this for the time being. Taking a look at the commodity boom, taking a look at the gold sector as well, in particular, companies like Northern Star that we recommended at $7. And, just for our webinar viewers, we have an exclusive deal for you guys. The vast majority of clients, I do have to admit, we have the gold package, which is our most simple basic package, where you get access to our daily finance report and of course our main income and growth portfolios, as well as our ETF portfolio, and of course dedicated account manager. That usually retails at about $1,500 per year. We've essentially cut that off just for you guys, 30% off, about $997 per annum. But the best value that you can probably get is the diamond package. And we've got the 3-year diamond package. It usually retails at $3,000 per annum. We've got a 3-year diamond package at a total of $3,997 total, right? That's essentially about a 70% discount. It's pretty crazy. You've got that daily income report. You've got the income and the growth report, but you've also got that mining report, which is very, very significant. It has been our best performer over the last 12 months. You've got a defensive bear portfolio. You've got access to our technical analysis software tools, all those other things. And of course, you have the capacity to have a portfolio review. Essentially, if you have any concerns about how your portfolio is looking currently, I'm sure a lot of our attendees do at the moment. A lot of our clients, of course, have been quite worried about how the current bear market is in the short term and medium term. You're able to give either myself or one of my other portfolio management colleagues or a couple of my analysts as well. You're able to do a portfolio review where we look and rebalance your portfolio, see what sectors you're overweight or underweight in, what particular stocks that you should be accumulating, what particular stocks should you just let go of, all those sorts of things to get your portfolio particularly on track. And that's the most important thing. And that's honestly where the vast majority of our clients generate the actual value from the service, having the capacity to speak to someone and see how your particular portfolio is going and see how we can help you. So if all of that sounds interesting to you, please feel free. You've got a chat box on the top right hand side. We've already got a couple of questions coming through from our webinar viewers, so thank you for that. Any questions that you may have post this webinar, please feel free to send us an email at admin@stockspecialist.com.au. We'll also send you a follow-up email later on today from our webinar provider here. So any questions that you may have, please don't hesitate to give us a call or send us an email, and we'll be more than happy to help you out. But again, once again, thank you so much to all our attendees, and we really appreciate you taking the time. We know that this is quite a tumultuous market, a very uncertain market, and this is something that we want to really help you guys out with. So as I said, thank you once again, and please, we really look forward to hearing from you in the future. Thank you, everyone, and enjoy the rest of your day.